Hey guys, it is October the 6th, and we're having quite the start to the month of October. I mean, we've got a couple of weeks before earnings season, and volatility is all over the map, but definitely upwards, which is, I think, what it should be because this earnings season is going to be crazy. Now, it's really 2 weeks until it all gets started. And so we are going to review today both what OPEC said yesterday and also what we're seeing with Apple and how to think about hedging. And I want to show this because I figure if I show it with Apple, which a lot of people own, inadequate size, and a lot of people would never sell because it's just been such a long-term core holding. But showing it here, it really is the same technique that you may want to consider for other stocks as far as that goes. And so we're going to go through that. But first, past performance is not indicative of future returns. I'm going to share my screen here. And we'll do the setup as well into why, what, and what is going on today for the context of all of this. Here's FinViz. You kind of have most of it looks to me like most of it's red. Obviously, energy is green because of OPEC's announcement. I want to show you the indices. They actually started off more or less flat, and they've been dancing plus or minus 50 basis points. I do think it's fascinating what's going on with oil because we see it going down and going up. And when you listen to the news, they talk about GDP being so weak that it will, in fact, overwhelm crude oil. And I got to say, I just think perhaps they're not understanding the nature of what's causing the GDP weakness. It's actually oil. So whenever oil gives up anything below what it's actually worth, oil should not be like the amount that GDP would have to decline would be so dramatic. And especially, or alternatively, the market would just have to feel highly uncertain such that it repriced all assets as it did with COVID. But you'll recall with COVID, oil went to 30. We literally had everyone not moving, period, and not showing up to work. So both, right? Right now, we're in a state where everybody's really worried that GDP weakness is going to make it hard to feed families. And also, by the way, because of the COVID period, we reduced grain stores so aggressively. The exact opposite should be the case. So I'm not sure how the economists are coming out on this. I'm not convinced that they're thinking it through, but this number is definitely weak. And like I said, winter is coming. Have a look at my past episode that probably should be entitled "Winter is Coming" for Europe. Let's see. I want to kind of go through today economic data. Really, the jobless claims are coming out as expected in my mind, but it really does tell you that we're starting to get some mitigation of turnover, and we are starting to get some more jobless claims, things like that. And then we also had all of these companies report more or less today. My initial look at the releases, which I will review in detail tomorrow, is that consumer staples actually doing really well, passing the cost through and making sure that they get at least some margin to maintain themselves in this environment. Because honestly, you don't want the consumer staple companies unable to make money, even if you think capitalism is the worst thing in the world, which I have heard more than one person suggest. Let's talk about OPEC really quick. Yesterday, they decided to cut production 2 million barrels per day. And then everybody's like, oh, well, that's only a 2% of global demand. And Goldman Sachs, this analyst, said that because of the nature of cuts that were synthetic, meaning there were some issues due to Western sanctions on Venezuela and Iran, had output problems in Nigeria and Angola. Because of these other extraneous, that 2 million really isn't a 2 million cut. It's actually those guys struggling to produce more. And then them actually cutting 400 to 600,000 barrels. Okay, here's the thing. There's 2 million less barrels, okay? Let's make it clear. I don't really care if the 2 million less barrels comes from the fact that countries are having problems producing, which is, by the way, a theme we've talked about and that we saw when Halliburton, Baker Hughes, et cetera, all the equipment companies, oil service and equipment companies reported that there's a problem getting the equipment to the right place to pump it out. Or if you just, as OPEC, decided that you didn't want to then do anything but cut oil further. What this tells me is that OPEC is annoyed that the price is where it's at, given that they are, largely speaking, in their own way, trying to stay out of it to the extent that they can or should. And that's despite the fact that, again, OPEC is a list of nations that is not US friendly, in my opinion. So all of that is a thing on the geopolitics. And also, I don't like, this isn't great that the reason that part of using the idea that a couple of countries had production difficulties to make a 2 million barrel cut look better is not better. I don't know another way to say it. Like you're basically telling me that they would have cut less if people had been able to produce more. That's like my worst nightmare as far as what you could get out of this meeting, as far as like what should be therefore bullish for oil. And I just want to remind people, like 2 million, what's that like? Because sometimes they say these numbers, and if you're kind of newer to this and you're getting the talking heads saying it, they try to like fluff it off like it's no big deal. It's actually a really big deal. Okay, you need to know that when you're looking at consumption and production numbers, that because of COVID, we had some massive decrease in production and consumption. So usually these are a little different, let's just say it that way. And in a lot of ways, I should have probably just pulled up 2019 so you could see it. But if this is an area that you care about, look at all the numbers. But I want to show you, we are the largest producing nation. The second largest producing nation typically is Russia, okay? And then Saudi Arabia is third, okay? Third. I'm so tired of people telling me that it's not, but it is, okay? And then Canada does produce a fair amount of oil. And then you have to subtract from that consumption to get a sense for whether you're importing or exporting. The only problem with using 2020 numbers, which is the only thing I could find on quick notice, is that 2020 has that COVID in it. So it is a little bit understated, so to speak. We're actually usually closer to 20 million. That's how I know it's understated, and so on and so forth. But, and also we have brought production up a lot. I need to add the rig count chart in here one day for you guys next time I talk about oil. We have brought production up a lot since 2021. We still need to continue to bring it up. We are, by the way, typically net exporters, and we are typically the low cost producer. But if you cut 2 million barrels out, realize that's a lot of barrels to cut out, because we're already on this list of top 10. So in other words, all of these in red, this is Saudi Arabia, United Arab Emirates, Kuwait, and Iran. Collectively, they're going to do 2 million less. And it's going to have to be made up for by someone. And that someone on this list could either be Canada or the United States. China right now is doing its own thing. Okay, first of all, China is burning way too much coal. So they probably would prefer to keep their oil. Plus, if you look at how much they produce and consume, they consume way more than they produce. So they're not going to help us out. You know what I mean? And then Brazil is probably going to help out a little bit, but it's just the extent to which they can increase. This is not, the consumption to production numbers aren't quite as wide. So it's really just us in Canada that might be able to make up that shortfall. That's why 2 million is not a small number. And I want you to remember too, that we have literally been giving up our reserves the entire time. This is not a renewable resource. Okay. So it really absolutely is the case that we borrow from today or borrow from the future of our own reserves to pay for the present. And that is, I don't know how long that's sustainable. We're not even currently in the months where it's the biggest problem, but we will be in about 2 months. So this has to be resolved. This is a very big deal. And it's part of the reason why I think oil today, I know everybody's really freaked out about GDP, but this is a very muted response to what has just happened. Now, let's get into Apple, because I think in general, all consumer products has been taking a hit. We know that the amount of freight that has been coming across has declined dramatically in July and August, and even September, October is just continuing to come straight down relative to historic measures. And in particular, we see Europe, the decline sharpen markedly in August, September for those companies have already reported. And then we see as well just the shipping, the shipping itself, containers, significantly less on board those ships. This is the time of the year that most people stock up for the holiday season, so it's not kind of an issue. As a result, with Apple, I know that these are things that you just don't buy, and you don't sell Apple. I get it. There's article after article with every single year time stamp on it that just says don't sell your Apple, but hedge your Apple for sure. Yes, right. And so let's just talk about Apple's earnings and why it is potentially at risk. Number one, obviously, most of the sales are going to consumer. There are some service revenues here, but you can kind of see if we just look at the number, most of the revenues here is service, and products was flat. Okay, a little bit down, flat to slightly down, but really let's just call it flat because you get some FX in there. Services was up a touch. Okay, you know, but overall, this number just barely skated by at 1.9%, which is not typical for Apple. Net income, though, came down 10%. Part of that, 4%, 6%, well, 4% of that was operating income. Okay. So it is a tougher operating environment. And we know that they are not increasing the amount of iPhones that they're going to make for iPhone 14. So I want to show you that in the mix. iPhone is one of the largest components of what they sell. Okay. So this is not great, for lack of a better way to talk about it. Additionally, I really just want to show that here was what it was. The 9 months ending, you kind of have to do the math. So 9 months ending, you still had the Mac and wearables businesses in the positive, but that's despite this quarter was down dramatically. So now we are going in the fourth quarter, but it's going to comp against last year. And by the way, guys, this only includes through June 25th. So yeah, we do have an announcement subsequent to that on new products, but you know, this isn't good going into the fourth quarter. Now, I also want to show you geographically, you can see where the weakness came from. You're getting Europe still growing at 2%, but we have a very different picture from the end of June to the beginning of July for Europe. Asia, developed Asia and China, or Japan and greater China, let's say it that way, really slowed down on the quarter. And some of that very small amount was made up for with the rest of Asia Pacific. So everything from Australia on over. But this is the smallest piece of their business. Really, we need to see what's happening in the US and Europe. And we know from CPI that comes out on the regular that consumer electronics has been kind of weak. So look, I'm not saying that Apple's going to go up or down. I'm saying this is a strong case that if I was still doing my old gigs, I would be trying to talk to people about, hey, should we talk about how we hedge Apple? Okay, so I want to just make this clear because the next slides I'm going to show you, do not do these trades if you do not own the stock. These trades will make no sense on a cash basis if you have a cash options account, or if you are going to just try to do them on a margin account. Because if you look at how much your broker should be asking you to reserve in capital, they won't make sense. Okay, your return on invested capital is no good. But if you own the stock, the margin requirement isn't nearly as bad because you'll basically be, one of the legs will be hedged out as a covered call. So what's interesting, and I just want to demonstrate approximately the thought process. You could do a caller, but I'm going to actually structure it as a put spread and then a put spread and then a short call. The two short pieces, the strangle on the outside, really paying for that put. And you can do it right now because right now the nature of the way both vol is elevated and also because the smile itself is a particular shape in most of the large cap names, you can do this for a fairly reasonable price. And there are some assumptions that you're going to be talking about. But, you know, if this is something you own a bunch of Apple or you own a bunch of various large cap names, whether it be Amazon, what have you, I'll try to highlight these over the next few days as we start to enter earnings season. Talk to your broker dealer, see if there's someone that's on the options desk, or, you know, Garula. Yeah, that's the company that is always hanging out here. We do have some sort of stuff that we can take a look at here. You should join us. We can talk about it, that sort of thing. My subscribers through the Garula do actually get that as a part of the conversations that we have. But do not do this if you do not own Apple stock. And remember that this assumes that you own a one for, 100 shares for every contract structure that you're doing stuff with. So here, let's do it. Assuming that you own Apple stock, you could, the week of earnings, the earnings is going to happen on the week of October 26th. That's what we're looking at. So this expiration would correspond with that week. Now, you have to keep looking and making sure that that's true. I was not able to find the actual date yet. But regardless, this gets you closer to earnings in case it's the following week, which can sometimes happen. What you can do, Apple currently trading at 146. If you want to be very, very conservative and just lock it in right here, you could do this. And this will give you protection all the way down to about 140. What you'll do is you'll pay 67 cents. This is a debit spread. You will short the 160s. You will short the 140s on October 22nd. This will pay for most of your put. And in doing so, you'll pay 67 cents, If Apple falls through 140, you will collect $4.30, which is just $5 minus the premium. If it goes over 160, yeah, you got to cover that call. Don't get me wrong. And this goes to zero. So you'll have spent 67 cents plus whatever loss you get as it moves past 160. Another way to think of it is that you will be selling Apple $15 higher, or 14 and change, whatever you want to call it, higher. So that is one way of doing it. If you're like, no, May, I don't think Apple's moving anywhere close to that. I think it doesn't move any higher than 155 in the next 2 weeks because it's just scary. Okay. All right. If that's the case, you actually can do it for 20 cents. This is actually what it would look like if you tightened all that up. So you just bring, we still keep that one leg 145 for 140, and then we just bring the upper leg down, because look, if you just look, this is what I'm saying as far as the shape of the smile for those of you a little bit more advanced, but the 50 cents here is like kind of, they're still really kind of wide trades, but basically that $2.50 will give you another 50 cents of premium to play with. And that thing only costs you 20 cents. You'll need to watch this upper leg. If it starts to rally towards that upper leg, it's going to feel a little awkward because that will come up, but it really does have to, look, this insurance is 20 cents. I don't know another way to say it. And you're probably gonna have to lift this leg as it gets closer to 157, but you have 2 weeks that you're covered for in the case that we continue to have downward volatility. And with that, the other thing is you could just do a pure caller and get rid of this leg, buy this puts and try to sell that premium against it. And then you're really covered in case your real concern is that Apple heads back down to 130, which 138, 137, as it did the last week or so. So with this 2-day rally, this is how, if you really feel passionately about hedging your portfolio, these are reasonable insurance premiums, in my opinion, to pay. And it's not always like that, because sometimes the smile is not as aggressively, it's just not always shaped this way, or alternatively, the vol is very low. And so when you go to do the math, it just doesn't make any sense. With that, let me go ahead and stop sharing, and we can chat more about it.
Hey, May. Yeah, that's a great way to I mean, you're going into earnings, which a surprise could hurt your value, right? You're paying a very low premium to hedge your investment.
Yeah. And the reason I kind of like it, and you don't have to do the week of earnings, you can even do the week before, because really the main issues that you have is like these banks, in theory, I mean, I would imagine relative to any other period, there's more confusion going into this quarter than any other quarter. This news out of Europe is weird, for lack of a better way to describe it. And you can look at the last 2 episodes I've done on Credit Suisse and the potential systemic risk that they currently are trying to work through, and as well as this UN piece off the heels of the UK lowering rates in the weirdest possible way. All of it is so strange. And then you have banks, and the banks, both the 4 major banks have an investment banking arm that probably is weak. Some of them may have made money off the net interest margin. We don't know how much, but now you've got potentially this weird oddity of a decrease in rates going forward. So honestly, you have to get past all of those banking reports as well, even above and beyond reporting a decent quarter. It's weird. I don't know another way to say it. It's going to be really.
Did you say you would do the week before or the week after?
You could do the week before or the week after. It just depends on where you're the most concerned. I would, if you're interested in hedging specifically, I mean, we always talk about it, but if somebody else offline is looking at these things, checking that structure both the week before and the week after to see what the pricing is and what you're trying to hedge is a good call, because you will have to, I mean, like, it usually is just company specific risk that you're trying to hedge. But right now you also have to hedge market risk. And what do I mean by that? I mean, we got some really weird stuff geopolitically. And now, because things have lingered for such an aggressive amount of time, we don't know what the banks are actually doing to make up for it, right?
Right. So you're saying put on the position a week before?
No, I'm saying either like my ideal would be for you to put it on the week of earnings for sure, right?
Right. Okay.
The week of earnings. If you were like, hey, I kind of want to put it on for the week before earnings and then just reset it the following week. That's probably fine too. It's sometimes hard to get it off because the options will shift and move around in a way that may not be conducive to you being able to recreate a similarly cost-effective trade. But I guess all I'm really mentioning, you're right, it's a little confusing what I'm saying. What I'm saying is that as bad as earnings week should be, the week before is also no picnic because we just don't know what's going to happen with these banks.
Oh, I see. Oh, okay. You're saying in cinnamon, it might be lower by then. Okay, I got you. Okay.
Yeah, because
It
I think
makes sense right now, 20 cents, 25 cents.
yeah, my
Okay.
real and then that 157, it kind of, I think that's for someone to decide if that's the right upper bound. If it's 160, you're paying 50 cents, which I still think is a pretty good deal to go ahead and hedge out like a 1%, like less than 1% move, it starts to pay you, you know what I mean? So like, so, whether it's 157 or 160, it's anyone's call. I'm worried. Here's what I worry about. JP Morgan, they definitely benefit from the increase in rates in theory, right? But it really depends on all the other businesses and what precisely is happening in the way of that particular of the business units that benefit from increase in net interest margins. Like, in other words, in those businesses, you also have to see loan growth. You have to see no additional reserves taken for losses. You have to see like all these other things that for the bigger banks, I don't have a really great call. And then especially the equities business, did they gain money or lose money this quarter? Its markets have been weird. And then on the asset management business, outflows or inflows, I mean, I think the asset management business is mostly going to look weak across all the, and then it's whether or not numbers have been taken down in line with that weakness. So I'm really worried about the first four banks coming out, but I think it would be impossible for anyone to make a real call on it because of the mix. Sometimes it's really easy. Banking is up, markets are up, fixed income is fine, la, la, la. And it's really obvious that the company's going to do well. But here, it really does depend on what exactly they're doing in these business units. And I don't like that. For lack of a better way to describe it, I don't like that.
Yeah. Okay. It's on any position you have, if you have 100 shares,
Yeah.
you should hedge it. I mean,
Yeah.
for 25 cents is nothing.
Yeah.
Okay. Very, very good strategy to use.
Yeah. I hope it's helpful to some because I know like this isn't a common conversation. All right. Well, tomorrow I will be talking about food and because there were some really interesting things in there, but I got to pull all of that out. So that'll be tomorrow's episode. Any other questions or should we just close it out early today?
Overall view of the market. I mean,
overall view of the market, I'm nervous because, and I wish I was like a lot more clever, but it's just that with Europe doing what it's doing and refusing to admit it, with a lot of the US companies, so like these Constellation brands, all the food companies are actually, they largely speaking came out really well, but they're coming out well by pushing inflation through and which is essentially getting pricing. That's what they call it. But really, when they get pricing, we feel inflation. That's what that is, right? Okay. And then you've got, it's really hard. Like I do really believe that we're going to end up as the Americas are going to end up not just a little bit better than Europe, but quite a bit better than Europe, because I'm not seeing them make the series of tough decisions that they have to make to resolve what's going on over there. So between the fact that we're going to need a bunch more geopolitical stuff to happen, and then Credit Suisse is a whammy. Like this market rally doesn't make any sense except that it, sorry to be like so conspiracy theory, but one thing that would absolutely make sense is if someone's trying to let Credit Suisse out of some trades, you know what I mean? But like that earning, the idea that they're trying to raise capital to move some of the structured products off, that's just weird, in so many ways that I can't even remotely explain given the nature of that business. And then, what does that then imply for the US investment banks? I don't know. And there's, I think it's highly uncertainty. And when there is uncertainty, you should be paying Like people will not pay you as much for an asset if the market's very uncertain. And to me, as a result, a red screen makes more sense than a green screen until we get that clarity.
Yeah, one thing I've learned, markets hate uncertainty.
Really hate uncertainty,
Right.
right? I mean, like it, and quite frankly, that's true of any asset class. If you're not sure that the house, if you're worried that there's going to be major housing crisis, then you also don't buy a house, it turns out. You know what I mean? Every asset class is the same. Well, right now, I don't know what's going on. So
Okay.
it's got to be a really attractive price for me to buy it. That's what
These Fed governors, I mean, they talk, and one today said he doesn't care if they don't care if unemployment goes up, they're still going to raise rates.
Yeah.
All they care about is inflation. So
yeah. And it's a fair point that they're coming at. They really like this OPEC thing is so bad. It's backed the developed markets into a massive corner. And it's specifically like, the thing is, this lower oil production absolutely means rates are going up, absolutely means that every country that could is going to have to slow down the economy, because otherwise, like it's not even inflation at this. It's not even like, oh my God, I want to control inflation prices. It's we can't have not enough oil. I mean, we're burning through reserves, for goodness sakes. Do you know what I mean? We're like literally burning through our reserves. This is just this isn't even about, oh, I want to learn the mechanics of the how economic inflation works and monetary policy. This is about OPEC has decided not to help a girl out, so she's got to deal with how much, coal, wood, whatever. This is like old school. What do I do through the winter? You know what I mean? Because for whatever reason, the one thing that we have absolutely shown that we're going to do is try to help Europe out in a variety of different ways. So it's not even like, it's like, I've got to feed my family here in the United States, and I've got to make sure that I've got some exports to try to keep that stable overseas. This is like a man with two families. Another way to say it.
yeah,
That's
exactly.
what OPEC that is.
Very good point. Okay.
So I got away with words sometimes, right? This is a man with two families, and neither one of them, or a woman with two families, and neither one has a job. That's what that is.
Expense overhead. Yeah, exactly. Okay.
We'll turn it into 2022. It'll be a lady that has two families with both of them with jobless. It's bad. That's what I'm saying. All right. Any other questions?
That's it. Thank you, May.
Take care. Bye.